You guys now know internally, doing a quick review of the overall FOMC sentiment from yesterday, why we saw a brief rally, and then the market just literally correct all the gains from yesterday and now trading below yesterday's lows. So in today's video breakdown, I want to touch base on you guys. That sounded weird. I want to touch base with you guys and I want to discuss and talk about the volatility in the total cryptocurrency market cap, what has recently taken place. I want to go over the fundamental backdrop and really go over thoroughly our updated report as to why the total cryptocurrency market cap did not rally after the FOMC press conference. Take a look at the retail side of things, kind of what's going on. Take a look at price action. We're going to go over some updated analysis on XRP by looking into the order flow. And then after that, I will transition and I will go over my MNQ trade for today, which I saw a lot of you guys catch. I will break this down like I did yesterday thoroughly from the top down, utilizing the higher time frame, going over why I was looking at executing trades in this specific area of interest today, and how I was able to make my biggest day in trading pretty much since I started trading futures of over $40,000 today in one trade. So really great stuff for you guys today. And then we will head into the weekend. All right. Starting here. All right. So this is the type of stuff that we try to avoid here in this community instead of just following aimlessly the retail side of things and headlines on Twitter, where yesterday a lot of people were thinking that because the Fed cut interest rates that we were going to see a rally, so on and so forth. I mean, you can see it in the headlines today, $150 billion added to the total cryptocurrency market cap. If we go over to the total cryptocurrency market cap and we take this post, you can see Watch a Guru put this out directly at a high, and since then the market has shed from this post. The market has shed over $200 billion, right? So why is that? Let's not be the confused retail crowd that exists on the internet, and let's remain educated. So we'll talk thoroughly through the fundamental report today and we will go over that. Before we get into that, let's just take a clean look at the XRP technical analysis. So real fast, in a video breakdown from 7 days ago that I updated for you guys, going over the order flow, we had mentioned that if we want to see any higher prices on XRP, we need to overcome the sell dark pool at about $2.28. And we need to see buyers start to throw up defense and aggressively step into the market at lower prices around $2 to $1.90. Real fast, taking a look over at the order flow and going over an update. On the daily time frame, you can see that the most recent price action, there's a huge sell wall that buyers made an attempt to push aggressively above. Here in this bullish candlestick, you can see a buy imbalance where a huge buy order came in at about $2.07 to make an attempt to break above the sell wall that currently exists at about $2.11. However, buyers failed. They got trapped at highs at about $2.15 and have since then retraced. Now coming back down into the support wall here, down at about $1.94 is our next area of interest. We have just recently started trading below $2, which now opens the door for lower prices. The next area of interest for buyers to defend is going to be that buy wall sitting at about $1.94. Anything below that on the daily time frame opens the door for these highlighted areas of interest at $1.89 to $1.84 for some possible reaccumulation on XRP. And if we break $1.84, the next area of interest is going to come in at $1.72 to $1.69. Nonetheless, our previous analysis over 7 days ago has stand accurate, where we mentioned not to expect any higher prices on XRP until we break above the institutional dark pool at 28 cents. That leads me over to the 4-hour time frame, just so that way you guys can more accurately see all of the sell walls that currently exist at those levels. Give me just 1 second. Okay, so this is the 4-hour time frame. You can see yesterday's price action. This is what I was talking about. We saw buyers try to make an aggressive attempt to push above the sell wall here that exists at $2.11. Here's that aggressive buyer. However, you can see sellers trapped buyers at highs, defended their previous aggressive sell-off area at roughly about $2.15. Support was broken. Sellers continued to trap buyers in bearish candlesticks. You can see buy volume trapped, followed through with sell walls, and they continue to push prices lower and lower. Now buyers have the possibility to defend at these lower prices. If they don't, sellers will likely become aggressive and follow through with sell volume with enough momentum to push prices beneath these lows, which then opens the door for those lower targets. My overall analysis still stands that until we break bullishly above and hold the $2.28 dark pool with trapped sellers at these areas where they were previously aggressive, followed through with aggressive buying above $2.28, then I'm not expecting any higher prices or sustainable recovery on XRP, even if we were to come back up into these levels. We need to see buyers throw up support underneath of price. We need to see sellers get trapped at $2.28. We need to see that level turn into support, and we need to see buyers follow through with enough aggression to start to break above all of the sell walls that exist above $2.28 before we can even start to comprehend higher prices on XRP, right? And that is yet to even take place. So you guys will definitely get another update from me before that happens, most likely heading into next week. But for now, considering that sellers are still heavily involved in this market, as you can see, sellers are continuing to trap buyers. I went over this in a previous call with you guys. I mentioned that as long as we continue to see the buy volume trapped inside of price action internally, we're likely to continue to see sellers overpower buyers. And we have yet to see these buy walls flip externally on price, support it, and create higher highs and higher lows, breaking through previous sell walls. So that update still remains intact. $2.28 still remains that key threshold that we need to see buyers break bullish above on the higher time frames before we can expect any higher prices on XRP. So for now, my eyes are oriented towards downside targets for possible reaccumulation if we can break below these current buy walls, which the lowest one rests at about $1.88. All right. So I really like the order flow because it gives you a really great visual on who is in control in the market. You can see clear as day that buyers are constantly getting trapped internally in price, and externally sellers are still in control, right? So great stuff there nonetheless. The upside targets on XRP still stand. In previous videos, let's just go back over to the trading view charts. Over on the trading view charts, real fast. If we ever were to break above $2.28, the next hurdle that we would need to see buyers overcome would be that $2.33 dark pool. Above $2.33, that could open the door for a revisitation of $2.63. Right now on my trading view, I have alarms set. You can see them here, the little tiny arrows. I have an alarm set at $1.92 to warn me that price is starting to come into that possible accumulation area over on the order flow. That accumulation area, you guys can see my coordinates are $1.89 to $1.84, where I will start to accumulate some XRP. That price action would look something like this. Price coming down into this area, liquidating any over-leveraged players that exist underneath of the previous buys at $1.90. Maybe some possible reaccumulation. Hopefully we see trapped sellers. Buyers throw up some aggression, hold $1.90 as support, and then maybe that leads to a possible recovery. If that does not happen, then that's going to open the door for my second accumulation area. You guys can see the coordinates, roughly about $1.72 to $1.66, where I have another alarm set slightly above that area at about $1.72, where if we break this threshold, then most likely that is the secondary area of interest that I will start to accumulate more XRP. Right underneath of that, we do have the buy delta, the buy dark pool at about $1.56 to be mindful of. But right now, those are the most immediate downside targets that I'm paying attention to if the current support that we are revisiting now at $1.99 to $1.88 does not hold. All right. Moving on. Now let's cover why the market is seeing this sell pressure. As you guys have seen, hopefully in the report today, the total cryptocurrency market cap is down about $76 billion on the day. Most retail traders are like, what the heck is going on? The Fed cut rates. I thought that that was net bullish for risk assets. Wrong, right? The forward guidance that we got from the Fed left the markets uncertain and painted a more hawkish tone. So, reading today's report so that way you guys thoroughly understand that landscape and nobody is confused, coupling that with what we need to pay attention to in the coming days ahead as we end 2025 if we want to see a sustainable risk on rally. After yesterday's FOMC, the market initially respected support because traders heard the third straight rate cut and neutral range and reacted to the headline. But once the dust settled and everyone actually digested the details, the picture that emerged was not fresh liquidity and new easing cycles. It was tight, uncertain, and limited relief, which is why we've now seen roughly around $69 billion wiped off the crypto market, and the entire move yesterday that we saw has now been given back. Yes, the Fed delivered another 25 basis point cut, but it came with three big red flags: deep internal division and a clear attempt by Powell to raise the bar for further cuts, and projections that still only show one cut per year in the years ahead before settling near a 3% neutral range. All these reports, mind you, by the way, guys and gals, that I've screenshotted here. One of them was from Robobank, another one was from ING, another one was from, I believe, Morgan Stanley, and another one was from Bloomberg. So all of these little tiny screenshots and highlights that I gave you guys were from fundamentals with credentials. You had three formal dissents from major Fed speakers. Goolsbee and Schmidt not wanting to cut at all, Fed Myron wanting a larger 50 basis point move, and the dot plot revealing six officials opposed to even this cut, which tells you it took a lot of political capital for Powell to get this one through. That's not the backdrop for an aggressive risk-on chase. That's a Fed telling you, or us, we did this, but don't get used to it. The statement tweak around the extent and timing of further adjustments and Powell's own language that policy is now in the broader range of neutral and the committee is well positioned to wait and see both signal that the insurance cut phase is likely over and the Fed is in a slower data by data mode. Markets have responded by only fully pricing in a single 25 basis point cut in June next year. And when the entire forward curve is saying one cut, then maybe we're done for a while. It's hard to justify a euphoric risk-on breakout in crypto or the Nasdaq for now until the data further supports it. On top of that, what looked like a potential liquidity win, the restart of Treasury bill purchases and the balance sheet expansion was very clearly framed as plumbing, not policy. The Fed is buying around $40 billion in T-bills over the next month just to maintain ample reserves and keep the Fed funds rate inside the target range, not to compress long-term yields or engineer a new quantitative easing wave. Powell even went out of his way to stress that these reserves and management purchases do not change the stance of monetary policy, which is exactly why assets like gold also stalled lower rates help. But a divided Fed that openly signals cuts could be a few and far between doesn't give markets the all clear to sprint into high beta. At the same time, the S&P or the SEP projections didn't scream urgency either. Growth was revised a bit higher in the out years, unemployment barely nudged, and inflation forecasts for 2025 to 2026 were actually revised slightly lower, which allows the Fed to argue we don't need to rush, we can take our time. Put simply, the outcome was a textbook hawkish cut. They moved, but they also told us cuts from here will be slower, more contested, and heavily data dependent. That kind of message does not fuel a rally up in crypto. It keeps traders cautious, fades the initial spike, and encourages profit taking on every push higher, which is exactly what we saw. Then we can add in a layer in the Bank of Japan risk and uncertainty, and you can see why crypto is feeling pressure instead of launching. Bank of Japan watchers are now openly talking about a hike to 0.75% next week, and then a path of maybe one hike roughly every 6 months out towards 1.5% terminal rates, with the multiple former officials and strategists warning that Ueda and his team already feel behind the curve. That is very important. Markets hate that phrase because a central bank that is behind the curve is a central bank that may eventually be forced into faster, more aggressive tightening if inflation or wage dynamics surprise to the upside. On top of that, you've already got JGB yields pushing towards 2% and talk that 10% yields could easily trade in a 2 to 3% range as fiscal stimulus and Takachi's government adds even more reflationary fuel. For global risk assets, that backdrop matters. A Bank of Japan that is slowly but surely exiting its ultra easy policy and flirting with risk of having to chase inflation means a higher probability of yen strength down the line, which we all know is not a positive catalyst for risk assets, especially futures and crypto. Carry trades being unwound and pockets of forced deleveraging. Crypto and tech are at the tip of that spear. So even though that the Fed isn't actively tightening, the global rate and FX structure is shifting in a way that makes investors nervous about being overexposed to the highest beta corners of the market. Looking ahead, that is why the market has not embraced a full risk-on mood. We have a Fed that cut but raised the bar for future easing, a dot plot that only shows one cut a year, internal divisions that make any additional move a political battle, and a Bank of Japan that may be about to start a multi-year tightening path from a position of being late. For our community, the key is to remember what still needs to happen for the market to regain confidence in a sustained easing path. We need to see, I highlighted this in bold for you guys, labor data that continues to cool gradually, not collapse, and inflation that continues to drift towards 2% without reaccelerating in wages or services. If the labor market cracks too fast, you introduce recessionary fears. If it runs too hot, you force the Fed back into a higher for longer stance. Both weigh on sentiment and could continue to put pressure on risk assets into 2026. And if at the same time the Bank of Japan ends up truly being behind the curve and is pushed into a faster tightening cycle, that adds another layer of volatility via FX and carry trade unwinds. Until those pieces line up softer but orderly, labor data, inflation easing for the right reasons, and no aggressive tightening shot from the Bank of Japan, markets are going to treat every rally as something to fade, not chase, which is exactly why we're seeing some sell pressure instead of an explosive risk on run after this week's FOMC. I added this in to put a little bit of hopeful optimism heading into 2026, where I said, I am hoping, but keep in mind, markets don't move on hope. But I'm hoping that clear regulations will allow crypto to decouple from traditional risk assets into 2026, which would be phenomenal, which will allow for a rally in crypto regardless if the risk-off backdrop continues. But again, that's a hope that could be far stretched from the actual reality that we see in 2026. So nonetheless, that is why we're seeing a risk-off mood today. After the Fed cut rates, we saw a hawkish cut. You guys now know internally, doing a quick review of the overall FOMC sentiment from yesterday, why we saw a brief rally, and then the market just literally correct all the gains from yesterday and now trading below yesterday's lows. Moving forward, tomorrow we have Fed speakers on the forefront to be mindful of, and over the weekend, we just still need to be paying attention to any geopolitical shocks or tariff updates that could surface in the headlines on Saturday and Sunday. All right. I'll make sure to update you guys over the weekend as we head into next week.